Stockholders' equity, part 2, accounting for stock issuance to non-employees, of course, to your shareholders. Stock issued above par. What does it mean? When a company sells stock for more than its par value, it's said that stock is issued at above par. Let's say if the par value of the stock is 10 per share, but the company sells it for $15, let's say. So what happens? We receive $15. This goes to cash. This extra $5, it goes to additional paid in capital, and the $10 goes to common stock. Simply you debit cash, credit common stock, and credit additional paid in capital. Next, stock issued at par. This is the situation when a company sells stock for its exact par value. A stock that has a par of $10 sells for $10. So you simply debit cash, credit common stock, as simple as it could get. Then the next one is interesting. Stock issued below par value. It's a situation when a company sells stock for less than its par value. Let's say the stock par is $10. We sell the stock at $8. Clearly, there's a difference of $2. So in this case, you're going to debit cash $8, debit additional paid in capital $2, and you credit $10 for common stock. Please remember the discount in this case is $2. It represents a contingent liability, and this liability is towards the original owner. So next we have stock subscription. So when a company sells stock through subscription agreement, it allows buyers to pay over time. For example, if 100 shares are sold and each share is priced at $10, but the buyer pays in installment. So we have a contract in which 100 shares are to be bought at $10. Once the buyer pays the full amount, they receive the stock certificate showing that they own the number of shares. So here the journal entry explanation of sale of subscription. What you see on the debit, this represents the amount owed by the subscriber, from the subscribers who agreed to buy 1,000 shares at 100 each. So we debit subscription receivable with $100,000. And the credit common stock subscribed. This represents the par value of 1,000 shares that we have that have been subscribed. The par value is 10, multiply with 1,000 shares, so we give credit to the common stock subscribed. What you see at the end is additional paid in capital. This is the excess amount over the par value of the subscriber agreed to pay. The sale price is, remember, 100, par is 10, so this $90 represents the additional paid in capital, right? So for these 1,000 shares, 90,000 goes to additional paid in capital. When cash is received from subscribers of shares, we debit cash, credit subscription receivable, and on the issuance of actual stock certificates, we debit the common stock subscribed. Like for example, 800 stocks or shares have been subscribed, so we debit common stock subscribed and credit the common stock issued. So we have seen these three: sale of subscription, first the entries, then collection of subscription, and then issuance of stock previously subscribed. Next we have a default forfeiture of subscription. So if someone doesn't pay all or maybe a part of their subscription, the company will follow the terms of the agreement, and the policies they may have to handle that situation like this. So usually the company will reverse the relevant part of the original entry and do one of the following. Let me show you. Issue stock in proportion to the amount paid, that is, give shares that match the amount the subscriber paid. Refund the partial payment, give back the money that was paid. Retain the partial payment, that is, keep the partial payment, means money may be kept as a penalty for not fulfilling the contract, and in that case we bring it to the part of as a part of the additional paid capital or additional contributed capital. Next we have stock rights. What are stock rights? Let's say, take a simple example. We have three shareholders, ABC. A holds 10% of our stock, B holds 60%, and C holds 30%. Let's say we are bringing another issue. We are offering 100 shares, but before these shares are offered to general public, these shares are offered to existing shareholders in proportion of their current holding. 10 shares would be offered to A, 60 to B, and 30 to C. This is called stock rights. So basically, stock rights give the existing shareholders the chance to buy more shares, usually at a price lower than the market value when these rights are given. So this is an option. If they want to buy, fine. If they don't want to, then the company has the right to sell these shares in market to the general public. And this is the journal entry with debit cash, record the cash received, credit common stock to record the par value of the share, and credit the additional paid in capital, that is the remaining amount of this transaction. Then we have other stock valuation issues. For example, sometimes we may have issued stock for some services received, and instead of giving cash, we issue our shares. So if a company gives stock in exchange for some services, the stock should be recorded at the fair value. Let us assume a company issues 1,000 shares of its common stock with a par value of $1 for services that we have received with the worth of $5,000. So the fair value of the stock is $5 per share, clearly. So what you do, you debit the service expense, whatever service you have taken. So you debit the expense, service expense, $5,000. You credit the common stock with par, and you credit the additional paid in capital with the difference. It's as simple as that. Distributions to shareholders. Okay. Dividend is normally the payment made by a company to shareholders. Clearly, it is made out of profits or retained earnings. It is mostly given in cash, but it can be in other forms also. So here we have some important terms to understand. Date of declaration, date of record, and date of payment. Let me explain each one by one. Let's say, what is date of declaration? This is the date when the company's board of directors announce that they will pay a certain dividend. Let's say the date is 1st of January 2024. This is the declaration date. So what happens on this date? We create a journal entry with debit retained earning and credit dividend payable. Let me write this down. Debit retained earning and credit dividend payable, for short. That's the date of declaration. Right? Debit, whatever the dividend declared, debit retained earning, credit dividend payable. Next is the date of record. The date of record is the date when the company determines who the shareholders are that will receive the dividends, because the ownership of the shares keep on changing very fast. So we need to determine who are the one who should receive the dividends, those who are entitled to receive dividends. So let's say the date of record is 15th January 2024. So what happens on this date? The company records the name of shareholders eligible for the dividend. Of course, it requires no journal entry. And lastly, the date of payment. This is the date when the company actually pays the dividends to the shareholders. Let's say it's 31st of January 2024. The company pays out the cash and removes the liability. What they do, they debit dividends payable, credit cash or bank. As simple as that. So this is your date of declaration. The company declares the dividend. Date of record, the company determines who are entitled to receive dividends, and this is the date when the dividends are paid. Now we have some various types of dividends to discuss. First is cash dividend. Remember, cash dividends, these are the payments made in cash to shareholders from the company's profits, of course, from the retained earnings. Cash dividends are declared and paid on common and preferred stock. And please remember, treasury stocks are not entitled to receive any dividends. Then we have property dividends, sometimes called in-kind dividends. These are the distribution of non-cash assets like inventories, like investments to shareholders. So these are the assets that are given to shareholders instead of cash. So what we do on the declaration date, the company must record the asset at fair value. And once it's, because remember in the US GAAP, assets are reported at original historical cost. So when we have to give any asset at like investment security, like some maybe piece of land or maybe some property, plant and equipment, that is surplus. So we revalue. First we bring the asset to its fair value, then any gain and loss is included in income statement, and then it is given as property dividend to our shareholders. Then we have scrip dividend. Sometimes company is short of cash, so instead of issuing cash dividends, company issues notes payable to shareholders. That's basically a promise to pay dividends later. So it is normally used when the companies do not have enough cash to pay immediately. So on the declaration date, the company simply reduces the retained earning, debiting the retained earning and credit the notes payable. So this is the way to pacify your shareholders that their money is still payable. So they will be pacified that they will receive some money in the future in the form of dividends. And there are certain scrip dividends that may include interest from the declaration date to the date of payment. Then we have another classification. This is interesting. Liquidating dividends. What is it basically? Dividends paid when the company's earnings are not enough. So this basically reduces the company's capital, that is additional paid-in capital. So these dividends reduce the company's total paid-in capital, because the amount, let's say, we have declared $400,000 dividend. Our retained earning only has got $300,000. So this difference of $100,000 goes from additional contributed capital. Any amount exceeding retained earning is deducted from additional paid-in capital, and then if that is not enough, then we deduct from common and preferred stock as applicable. This is called liquidating dividends. Stock dividends, what it is: when a company gives additional shares of its own stock to its shareholders instead of cash, this is called stock dividend. There are two possibilities. One, when the company issues a small stock dividend. A small stock dividend involves when a company distributes less than 20 to 25% of the existing shares as dividends. This is an important point to understand, because they are treated differently. If there is a stock dividend which is more than 20 to 25%, they have totally different accounting treatment. So let us discuss these one by one. Small stock dividend means a stock dividend that is less than the 20 to 25% of the existing shares. This is considered as a small stock dividend, as the name suggests. Why is it small? Because it doesn't significantly affect the stock price of the company. So what we do in this small stock dividend, we debit retained earnings. Of course, all dividends go out of retained earning, whether it's cash dividend, whether it's property dividend, and of course stock dividend. So in case of small stock dividend, we debit the retained earning with the fair market value of those shares we are giving as stock dividend. Let me show you how. Capital Corporation has 100,000 shares of 10 par value common stock outstanding. The company declares a stock dividend of 5,000 shares, which is clearly 5%, when the fair market value was 15 on the date of declaration. So 5,000 shares being offered, it is what percentage of the existing outstanding stock? 5%. So it's clearly less than 20 to 25% of the existing shares. And this is clearly considered as a small stock dividend. So what we do, please remember, these shares being offered as stock dividend, small stock dividend, they are debited to retained earning, not at their par, rather at their market price. So 5,000 shares times 15, debit is to the retained earning, that is the fair value of the stock. Credit goes to common stock clearly at par, and the difference goes to paid-in capital or additional contributed capital. What happens when the shares given a stock dividend is above 20 to 25% of the existing shares? Let me show you. LMT Corporation declares 40% stock dividend on its 1 million shares of outstanding 10 par common stock. On that date of declaration, LMT's stock market price was $20. That is irrelevant in case of large stock dividend that is greater than 20 to 25%. So clearly 40% is above the threshold. How many shares are going to issue? 400,000 shares, because 1 million's 40% is 400,000. So total stock we need to issue 400,000. What is the value, par value of these shares? 400,000 times 10 per share as a par, 4 million. We ignore market price, we simply consider the par. So this is the journal entry. You debit retained earning 4 million, credit common stock distributable, and once the stocks are issued, we debit common stock distributable, credit common stock at par. There is no additional contributed capital here. So what about stock dividends on treasury stock? We know cash dividend isn't payable on treasury stock. What about stock dividends? General rule is that stock dividends are usually not given on treasury stock, because these shares are not considered active or they are not outstanding. But there is an exception. Some state laws may require the treasury stock must be protected from losing value. So stock dividends may be given on treasury stock in these cases. So these are exceptions. Generally, stock dividends are not given to treasury stockholders or in the treasury stock, which is the stock held by the company. Then we have stock splits. What are stock splits? A stock split happens when a company increases the number of its shares by giving more shares to its current shareholders. For example, you have a stock with a par of $10 and company decides to go for a split 10 for 1. So now there are going to be 10 new shares with $1 par. This is called stock split. So what happens? You have got more number of shares, but the par has reduced. So what is the impact? Stock split usually doesn't affect retained earnings or the total equity of shareholders. it just increases the number of shares. And since now there are more shares, there will be more turnover. This is the reason why many companies go for stock splits, so in order to increase the turnover of their stock in the market. Then what is a reverse stock split? Reverse stock split goes in the opposite direction. It reduces the number of shares a company has and it increases the par value. Consider company has $1 shares outstanding and company combines 10 such shares to make a single large share of $10 each. Right? So this is normally done by recalling existing stock certificates and issuing new ones. So for both, whether it's stock split or reverse stock split, it requires no journal entries. In stock splits, you have one share broken down into smaller parts, and in reverse stock splits, you move in the opposite direction. So it requires no journal entry. Then next we have important point, stock splits on treasury stock. So what is the general rule? Stock splits are typically not applied to treasury stock. We know what treasury stock are, the company's own stock that it has repurchased. And why is it so? Because these shares are not considered active or outstanding, as we discussed a little while ago. However, some state laws require that treasury stock must be protected from losing value. So stock split may be applied to treasury stock in such cases. And then finally, we have a statement of changes in equity shown on your screen. What this tells you, it shows you the details about the company's various equity accounts and what has happened over the period. So basically it shows you the reconciliation of various equity accounts from the opening till closing. So it shows you what? It shows you the capital transaction, that is the changes related to issuing or buying back shares, distribution to shareholders, that is payments made to shareholders like dividends that goes out of retained earning, reconciliation of retained earning opening balance with the closing balance, you can see here, and overall reconciliation of equity, the opening balance of various equity accounts, certain changes occurred, and the ending balance of these accounts at the end of the period. So this is called the statement of changes in equity, and that closes our topic stockholders equity part.